Good morning, afternoon, and evening, and welcome to the Coinbase Institutional podcast. I'm going to start with the most common question I've been asked in the last week. Are we in a bull market? That's it. I'm going to start with you. You're kind of closer to the DeFi world. You're probably looking at some of the metrics there. I know it's been a very interesting week, certainly in the Solana space, which is interesting post our conversation with Tushar last week. What do you think? When you look on chain, are we in a bull market yet?
This year really reminds me of early to mid 2020, the kind of excitement, which is kind of the beginnings of a bull market from everything I'm seeing on chain, users interacting with dApps, also bridging to multiple layers. But except today, we have so much more infrastructure to play with. So it's kind of where the capital flows will be really interesting. Like you mentioned, Solana is one candidate where it's been there for the past few weeks, but we have all these other L2s as well. So let's see where the capital flows.
Yeah, and one thing on Solana specifically, so I was sent something yesterday by someone where the volume in USDC on Solana was higher than the TVL. Now, what does that mean, and like, what can we attribute that to potentially?
It's extremely cheap, obviously, as a chain, and then there's several new innovative dexes that have kind of launched in Solana, order book based dexes, because the chain can facilitate orders on an order book at scale. And so, just trading volumes are pretty high there, especially as folks try to rack up volumes to be on the leaderboards, perform airdrops, etc. So these kind of new scope of projects are kind of a vanguard of the new Solana dApps, as opposed to the previous era of FTX-backed kind of dApps on Solana.
Interesting. Well, more on that later. Solana's certainly not going away. So we're also going to cover today a survey that Georg put together of the largest institutional clients that Coinbase works with and what they're thinking about crypto today. So the full survey covered expectations around BTC and ETH ETFs, the halving, positioning, price action through the end of the year, favored altcoins, and much more. We're going to include a few highlights, and for those clients that didn't get a chance to complete it and you'd like to receive the full presentation, please contact the desk and we can help make that true. Also on the agenda, we've got David covering macro. We had some data out this morning. Greg's going to cover flows, which have been picking up recently, and then we're going to go back to Sid on other parts of DeFi that are interesting. Some quick housekeeping. If you are watching on YouTube, please don't forget to scan that QR code to check out all of David and the team's fantastic research. That will be in the show notes. And also don't forget to like and subscribe, please. You'll get that alert, so you get to hear our lovely voices every single week, which I'm sure you don't want to miss. But without further ado, Georg, let's get right into it with the institutional survey, please.
Yeah, thanks, Ben. So as you say, we did a crypto market survey with a number of our super high-profile institutional clients to get an idea essentially of how they are feeling about the market at the moment. We asked a range of questions, starting from price predictions in Bitcoin and ETH, questions on staking and the adoption of liquid staking derivatives, ETFs. Meaning, when are clients thinking ETFs going to get approved? What does success in terms of assets under management look like? And most critically, the positioning. I do think that there is some alpha in there. And we picked, as you say, a couple of highlights just to share with our listeners here. So basically, if you look at this slide, we asked how our clients are positioned in Bitcoin going into the year end. And you can see that about 85% answered this with long or max long. Maybe just taking a step back, actually. So you had five, for our listeners, 5 options to answer this question, starting at max short, neutral, long, and max long. So deliberately kept a little bit vague, but gives you a fairly good idea of the direction of travel. So 85%, as mentioned, answered this with long or max long, and no one is short or max short, obviously, with a relatively small percentage, around 15%, as neutral. And I think for me personally, Ben, this was pretty much as expected, just given that you had this ETF narrative theme being the major thing ever since BlackRock announced the filing in mid-June, and I think it certainly also helps to explain the price action in Bitcoin versus ETH or the other altcoins as well, where Bitcoin has been really massively outperforming pretty much most of the time since the summer until now.
Now, thanks for that, George. We'd love to bring in David and Greg. Now, Greg, starting with you, we were chatting the other week about in one of the sharp moves higher, we saw people getting liquidated in BTC, and we just couldn't understand why people were going to be short. But what does this say to you? Like, does this kind of make sense with the conversations you're having? And I always love these reports because they're anonymous, so people can put what they really feel, as opposed to having a conversation where you might be a little sheepish to say you're max long when Bitcoin's up, how far it's up so far this year.
Yeah, no, I agree. This is a great report. I think the Bitcoin positioning affirms what we thought was going on. Just speaking to clients, and as you mentioned, we were very surprised that anyone was short a few weeks ago. I think maybe those shorts were people just putting on perp funding trades and things like that. But no, I think this broadly aligns with what we are hearing from clients, and that everybody that is in crypto is in this Bitcoin trade in some way, shape, or form. Some are obviously a little longer than others, but for the most part, the market's well positioned here. Now, does that mean that it can't continue? Generally, it might. However, everybody's positioning for the massive flows that the ETF will unlock. So it's really, this ETF's really going to change the dynamics of the market. So even though, again, almost every client is in Bitcoin, I wouldn't call positioning stretched at this point.
How about you, David? What were your takeaways?
Yeah, I agree with Greg. This is consistent with what we've been saying in terms of there being a floor on Bitcoin. But the challenge right now is with, positioning this heavy, and, we can debate that. I think Greg makes a fine point that positioning isn't necessarily full tilt and extended as much as the survey may suggest, for example. But if indeed positioning is still biased long, then what's going to happen once an ETF gets approved? And I think the timeline is kind of broken up into several parts. Number one is, when will we actually see the approval? The window is actually open right now to see an ETF getting approved. We still have the government shutdown happening in about 3 days from now. So that puts a challenge as far as the timing for the SEC to actually react here. Will they actually do it before the government shutdown and potential furlough of 90% of its staff? We don't really know. But beyond that, what will happen in the interim between a potential approval and then the actual launch of the ETFs? Will people actually buy the rumor, sell the fact? Will they actually continue being positioned long here? I think that is the unknown variable at this point.
Yeah, and that's some really, really good points there. We obviously covered Ethereum in the report as well. We're not going to cover it in the call, but I guess what's interesting, if we're looking at the discounts for the Grayscale products, those discounts now are almost trading at par. Certainly the gap between GBTC and ETH is at its narrowest, with GBTC in around the 10 to 12% and ETH around sort of 12 to 13, which is kind of crazy. So that's certainly pricing it as if it's going to come soon and it's going to be a very positive thing. Now, moving on, George, what were people thinking around approval dates? David touched upon it a second ago, but what was the data there?
Yeah. So another question that we asked here is essentially number one, when do our clients expect a Bitcoin ETF to launch? And you can see here that about 60% think it's going to be Q1 next year. Roughly 22% were saying it's going to actually come this quarter, and the rest thinking that it's going to take a little bit longer for most part into the back end of next year. But actually, commenting on what David just touched upon in terms of how inflows are going to look, what success is going to look like. I think for the most interesting thing for me is the expectations of success here. As you can see, there has been a very wide range of responses submitted, and the way we specifically phrase the question is, what is the total AUM going to look like a 1 month post-launch, aggregated across all of the new Bitcoin spot ETFs. So that's X Grayscale. And the range of responses, as you can see here on the slide, is from $500 million to $40 billion. So that's obviously pretty wide. But obviously, now if you look at the median, which for me sounded quite reasonable, that's at about 3.5 billion after the first month. There's been some research reports out there, circulating in the last month or two, where I've seen estimates looking at the 1 year mark and total AUM across all products, putting that at somewhere around 15 billion. So I think 3.5 yards after the first month doesn't seem like completely unreasonable, because it could essentially be take the shape of the inflows could take the shape of more or less a square root function. Essentially, we have a relatively fast growth initially the first couple of months, and then it would taper off more or less. And these 3.5 yards figure, thinking about it this way, I think makes some sense.
Perfect. And David, just bring you back here. How does that compare to maybe some of the other launches we've had in the past? Obviously, the ETH launch recently wasn't as popular as perhaps we would have hoped, but we have had some very popular launches in the past, most notably back in 21 when we had the BTC Futures ETF. So kind of how should we think about those numbers relative to some of the previous launches?
So yeah, I mean, first thing I would say, Ben, is I think it's important to look at flows. We're a market player, so of course this is going to be something that we pay attention to in terms of what's actually going to attract, how is this going to affect performance. But honestly, I do think that this is a bit of a distraction from the larger kind of transformation taking place right now, because these ETFs are probably going to bring in new financial products, because when you have something that is compliance friendly, regulation friendly, like a spot Bitcoin ETF, for example, that can invite new products as far as lending in terms of derivatives. And I think that's kind of gone unnoticed, or at least not discussed heavily by market players. And I think that's kind of a really big kind of miss from a lot of people, because that's where I think a lot of the inflows are going to come from. What we have seen from the past in terms of their experience with the ProShares Bitcoin futures linked ETF, for example, is that we got around like $1.2 billion of inflows within the first week. And that, however, was a very different environment than the one we're currently in. Like that was around the peak of the last bull market cycle. The trading regime in terms of the macro environment was also very different, because that was right before we saw a transition from Federal Reserve as well as other central banks in terms of tightening monetary policies to retaining the easier monetary policies that they were under. So I think that this makes it hard to kind of have these one-to-one kind of analogies. A lot of people compare this to what we saw in the gold market, for example. But even there, I would say that things are very different, because the way Bitcoin is perceived as far as its fixed supply schedule is very different as far as the inelastic nature that it has relative to gold, where yes, it can be difficult, but for the most part, if you want, theoretically, you could increase the amount of gold supply relative to prices rising. We can debate that as much as you want, but it is true. Whereas like you cannot do that with Bitcoin, which I think makes it very unique. So I think that we will see some of these differences and having a bit of an impact as far as the flows that we can get out of this potential ETF approval.
And Greg, let's say we got $3.5 billion in the first month. What do you think that does to the market? And like, let's think about it from a futures perspective as well as spot. Like, how do you think that the market responds?
Yeah, it's a really good question. It's one that we get asked quite a bit. There have been some folks that have tried to crack this nut, and it's just really, really hard to do it with any precision. Bitcoin today in the last 24 hours has traded $9 billion. A few days prior, we had days as high as $20 billion. So it's a relatively liquid asset. That being said, you put 3, 4, 5 billion of new money into the market. It's obviously going to move us up. Now, how far? At this point, it would really be a guess. I think, crypto being such a momentum-driven market, what's really important for me is that this ETF, is going to open up new pockets of money. So if you have the price moving up and you have an easy product for people to, get involved with, I would expect where, significantly higher, at least a 4 handle, if inflows do surprise to the upside.
Nice. Thanks, Greg. Thanks, David. And George, back to you for the last slide that we're going to show today around the halving. So historically, this has been a positive metric for Bitcoin. But what do people think about this next halving next year?
Yeah, 100%. So obviously, we now just covered the ETF, and if you look at the key parts that form this bull case for Bitcoin, it's obviously the ETF that we just spoke about, peak rates, peak US dollar potentially. From a macro perspective, Bitcoin as a hedge for an unsustainable fiscal policy, and as you say, the halving, which is another key component in that bull case going into next year. So the question that we have asked is our institutional clients is just to try to help to understand how meaningful they think it will be going for prices. And we just asked them to rank this on a scale from 1 to 10. And on average, the response we got is that most are thinking it's going to be a 6 or a 7, which is interesting in the context that, there are always these discussions around whether the importance of cycles goes down with time, because obviously, if you compare us now to the last halving, there's probably thousands of new coins, right? So and the market does have a limited attention span. So that was interesting and perhaps slightly surprising to me, because I would have maybe guessed, an average of perhaps 5, maybe a little bit lower, like 4.5, if you want to look at continuous rather than discrete numbers. So that was pretty interesting from that perspective. And I guess the other angle here is miners now obviously are quite happy, right, with prices having moved up, but still getting all those rewards pre the halving. So that's going to be another interesting sector to watch how they develop.
Thanks, George. Now, David, we'd love to kind of hear your thoughts about the halving and how impactful you feel that could be.
When we first saw the results, I think George and I kind of debated it because he was a bit surprised. He thought the number should actually be lower. I actually think that this is pricing it just about right. For me, the Bitcoin halving isn't necessarily about the event itself. I think this is a question of causality, right? I think, unfortunately, in people's minds, people believe that you get the halving and that creates this price performance. But I think what the halving does is actually, solidify the narrative around people's minds. And it depends a lot on the context in which it happens. In my mind, I believe that 2024 will be a difficult time for the macroeconomic cycle, but I don't think it's going to be a bad one for crypto, because ultimately, I think we're still going to see vulnerable, like banks, for example, because we have a commercial real estate sector that's still very challenging. I think that we're going to see that fiscal dominance is going to be a very big issue in 2024, which kind of puts monetary policy in a very difficult position. I don't think they're going to remain quite as tight as they will. And I think in that context, I could see that Bitcoin, with its, as I just mentioned, the fixed supply schedule with inelasticity, I mean, that tends to actually resonate quite well in an environment where, for example, the M2 global money supply is actually increasing. So I think things like that are going to be very important. But I don't think it's about the halving, or rather not the halving alone, but rather like what the halving represents as far as like Bitcoin's ultimate like attributes that really kind of will push up the performance.
Well, that is the end of our coverage on the report. As I said, if you are a client, please reach out to the desk and we can give you the full report that covers a ton more with some really super interesting insights. I thought the bits for me that I found super interesting were certainly positioning around ETH as well, and certainly around the ETH ETF and other kind of longer tail assets. So yeah, reach out to this if you'd like to see more of that. Now, George, back to you, please, for the latest news.
Yeah, Ben. So just looking at what's happened in the market and the price action, it definitely, going back to your initial remarks, definitely does feel like a bull market again. I would say price action over the last week has been pretty strong, with BTC rallying as high as 38,000 and currently up around 5% on the week. ETH is also starting to catch up, outperforming BTC by almost 4% over the last week, now up around 9% over the week. And this was obviously helped by, I think, what was the key headline over the last week, which is BlackRock planning an ETH spot ETF. But I think some of the real stars have actually been in the altcoin segment. So we had a new launch from Salestrader, which, unlike a normal L1, is essentially trying to decouple the consensus and execution layers of traditional blockchains. and their token performed really well, up around 124.5%. Over this week. And funnily enough, actually, if you continue looking at altcoins, FTT was up 170%. So that's a top performer over the last 7 days. And I think, ultimately it's kind of, on the one hand, a function of the market overall doing really well. So, the rising tide lifting all the boats in a way. And then you had renewed talk about relaunch of the FTX exchange on buoyant markets, obviously, and with claims there trading up as well. But there were also some underperformers. So Avi, to name one, which is down 5%. Over the last week after there was some talk about a vulnerability that came to light on November 4th, impacting lending markets, but this has been fixed since, and I think all the activities have restarted since then as well.
So George, in the last bull market, we got a lot of kind of new, large, kind of very high-profile token launches. Kind of, how do you think about those with regards to kind of where we are in the current market cycle and what we could expect going forwards?
Yeah, as you say, so there's been a lot of grandiose token launches like that, really hyped up protocols. And as you say, like, a lot of the charts have started looking very similar. They kind of like keep going down in a one-way street in a way. And oftentimes these have been tokens that start with a low float, low market cap, but very high FDVs and pretty, I'll say, aggressive tokenomics. So part of it, I think, why that happened is obviously reduced appetite during the bear market, if you want to look at it from a demand supply perspective, with the other part obviously being the supply or tokenomics, where I think protocols nowadays under a lot of pressure to have a more sustainable solution. And actually this was a big topic at Duong in Lisbon about 10 days ago, where things like, if you look at governance as well, quadratic voting were discussed, or, dispersing incentives from protocols over the longer term to attract more actually organic users and developers that are committed over the longer term. And actually in one of the panels, Optimism was named as a good example of a protocol that handled tokenomics pretty well. The other thing actually in that context that's interesting is airdrops. And there was one talk at Duong that looked at using sort of traditional finance metrics like the juxtaposition of the customer acquisition cost versus the lifetime generated revenue of a customer or user. And in this instance, for instance, they were using airdrops as a proxy for that customer acquisition value. If you look at some of them, something that stuck in my mind is Uni, for instance. Looking at the cost of the airdrop at that time when it happened, it was around $10,000 per user. But an even more extreme one is actually Ape, which was obviously the largest airdrop in history at over $8.5 billion at that particular time, which runs at more than $500,000 per user at that time. And this is obviously quite interesting to compare, like if you make the bridge to banks or Web2 companies like, Spotify or Netflix, where typically you'd be looking at a couple of $100, maybe $1,000 as the customer acquisition cost. So I think there's certainly going to be a lot more sensitivity in looking at how efficient money is spent in airdrops. And by the way, if you're interested in some of the talks, I think there was a couple of great ones. I think they should be uploaded now. Should definitely have a look online.
Amazing. Thanks, George. I was kind of cursing myself for not being vaguely artistic at school and like having any interest in apes. That might have been quite a nice airdrop. Cool. Well, thank you very much, George. David, over to you. What's going on in the macro world? I know we've got some data this morning. Perhaps you could run us through that and what else you're looking at.
Yeah, absolutely. So we got inflation this morning, but I think the first point I want to make about the current regime we're kind of trading in right now is we are firmly in a bad news is good news environment. And I think that means that anything that shows, for example, like the labor market weakening, housing is softer, all of that is being interpreted as good news and a market rally. So I think knowing that and understanding that, like everything kind of falls from that, and that's kind of where inflation falls into this. And within that context, for example, I think if you think inflation is still the problem here, then logically it follows that you believe the Fed is being earnest when it says, it wants to keep rates higher for longer. But hopefully a lot of our listeners remember when I said, I can't even remember when I said this anymore. It was a few weeks ago, maybe 2 months ago. I said that we've already seen the peak of acyclical inflation. And, this wasn't recent. There's actually a good chart that I have in our slide deck, which kind of shows that this actually happened around January of 2022. And what we've been dealing with since then has actually been cyclical inflation. So I think, cyclical inflation only peaked a few months ago. And we're seeing kind of the result of that right now. Now, the interesting thing about with the data we got this morning is that core CPI has actually been trending lower for months now, and it came in at around 4.1%. That was below expectations, for example. But it's been interesting to see this happen without any meaningful weakness in the actual economy. So the U.S. economy has actually been humming along, and we've kind of gone over reasons why this has happened, right? Some of this has to do with incentives being provided by the U.S. government to manufacturers. A lot of it has to do with just fiscal spending, which of course, contributes, like the subsidies that I just mentioned contributes to that. But I think what we're getting right now is probably the tail end of any of this kind of percolating inside the U.S. economy. Like I genuinely expect that we're going to see more weakness coming in here. We will see that hopefully in the retail sales data tomorrow. So Wednesday morning, we're going to get that. I think expectations have already been set fairly high because we've seen this measure actually beat a lot of forecasts in the last few months. But going into December, we've already seen a lot of the hiring for the holidays actually being wrapped up. I personally do believe the labor market has already kind of peaked, and we're starting to see kind of slippages as far as the wage data, the wage growth. And I think that's going to be important as we get into Q1. So what I expect for the rest of the fourth quarter is that, we're going to still remain in a very constructive environment that's going to pertain to both, stocks as well as crypto. Crypto, of course, the pace of it's probably going to be somewhat slower because we've already seen this giant 4 standard deviation move over the last 2 weeks. So more likely it's going to continue grinding around here. Maybe it's going to do better. Maybe there'll be pockets of, opportunity for alts or other ones. But, to the question that you asked at the top of the show, Ben, are we in a new bull market cycle? It's not just contingent on performance alone. It has a lot to do with how sustainable this is. And I think that's what's going to determine this. And we really just don't know at this point.
Thanks, David. I love the way you frame that. And it feels like, so for the end of through to the end of the year, we're kind of looking okay. But I'm curious, for Q1 of next year, Q2 of next year, it's certainly an area where when we speak to a number of clients, they're far less clear. How are you thinking about that? And what are some of the data points you're going to be keeping a close eye on to try and help navigate early 2024?
Yeah, I would say barring a few exceptions, most people are very low conviction in terms of what they see for the first quarter of 2024. Maybe a little bit less so for second quarter of 2024, which is weird, right? When usually you have a longer period of time, the further out you go, it's more uncertainty. But Q1 actually tends to be more of a black box because we don't know what the data is going to look like. We don't know if we're going to get a recession, and we don't know how the Fed's going to react. We think ultimately coming out of that, at least I think coming out of that, probably in the second quarter, it's going to be highly likely that we'll see a Fed need to change its position and actually start to cut rates. And this is kind of what we've been getting at in terms of the economic data and the trajectory for inflation. But where the exceptions lie are people who have very strong views about inflation being intractable here, that high inflation is going to be the problem that we're going to be dealing with for the duration of the next 6 months to 12 months. Versus people who believe, like I do, that the trajectory has already turned and that inflation is actually coming down. And that if we see any impact on the economy, that is only going to strengthen the arguments for the Fed to actually change their position. Now, I also believe that fiscal dominance isn't a question that people have been really thinking about as heavily. And, this isn't, of course, a mandate coming from the Fed. The Fed doesn't focus on that. The Fed tends to focus on inflation, full employment, in terms of financial stability and its markets. But I think there is this question of, if the burden on the government to continue borrowing is higher, and we've seen that it is, and we've seen that the supply on the Treasury side has increased, like, does this change the Fed's mind? And they've so far said, this is not our purview, we don't deal with it. But in my mind, I think that they doth protest too much, and that this is going to become a question whether they wanted to or not. And that is going to be the question that burns for me in first quarter 2024, which also contributes to the changing position that they may have. So TLDR is, I tend to believe that first quarter probably it may actually tend towards the weaker side for risk assets, but probably in the second quarter we'll see that kind of recovery happen. But I don't hold that view too strongly. I'll be completely honest, because there is a lot of uncertainty going into that.
That's great. Thanks, David. Well, we're certainly seeing on the desk that folks are taking the positive stance from a flow perspective. So, Greg, we'd love to bring you in here and run us through like what we're seeing on the desk. And I know we're seeing some new money, some returning money. Volumes are up. It's feeling slightly better. Like, can you run us through what we're seeing?
Yeah, absolutely. You know, the theme of this show seems to be, are we in a bull market? That's a little funny to me because generally we characterize bull markets as assets that are up 20%. We're up 100% this year. But this is crypto. It is a little different. And I would say even though we're up 100%, it feels, being on the desk and talking to clients, that we're at just the beginning of a bull market. You know, this slide here has exchange volumes. And what you're seeing is we're getting higher and higher volumes as we move through time. And that's a really healthy thing to see, especially when it's combined with positive price action. So this is something we're keeping a very close eye on. Additionally, you know, you mentioned new money coming into the space. This is something we get asked about all the time. You're absolutely right. We are seeing, you know, a decent amount of new entrants into the space. These are either folks that had traded previously and then had left for some period of time and are now coming back, or people that, you know, had been looking at the crypto market for a while, never really got involved, felt, you know, that was a good miss. And now they're seeing things, you know, in their analysis that's bringing them back into the market. And I would say that's across multiple client segments. So, you know, your ultra high net worth, crypto, you know, some crypto asset managers are moving further out the risk curve, you know, TradFi, and your traditional hedge funds. So very, very good things to see there.
Yeah, and even just looking at your chart here, like if looking at, you've got, as you said, higher highs, you've got higher lows, just looking at like basic technicals. And as you said, like we're seeing the same thing in Bitcoin and Ethereum and many other assets aligned with strong volumes, which is typically a good sign. What else are we hearing and seeing on the desk, Greg?
Yes, we have another chart that I think is important, especially around this, you know, where are we narrative. So this is a chart that we used to show quite a bit, and then we stopped because it got rather boring. It's this is the breakdown of assets that are traded on the Coinbase exchange. And for a while, it was, this whole pie was dominated by BTC, ETH, and then there was a tail of other assets. This chart today, which shows the breakdown over the last 7 days, is very different. BTC and ETH still are a large portion, but we're seeing volume move into some of the altcoins, Solana, Link, XRP, and others. And again, that's generally a healthy thing to see for our ecosystem. We can't be a market that's just driven by one or two assets. Now, whether or not the rally in altcoins, which I think surprised everybody, or nearly everybody that I spoke to at least, continues, again, I think this is a data point that for me is very positive.
Yeah, I agree. Looking at that chart, like seeing Sol, Link, there's a few others on there which maybe I wouldn't expect to see, or perhaps would expect to see but won't comment on. But no, I agree. It's good to see a far more kind of split wheel versus Bitcoin at 70%, we've probably seen at certain parts of this year. And then what about other technical things, thinking through like basis and GBC and things like that?
Yeah, so the grayscale trusts have tightened quite a bit. Both GBTC and ETH are trading around, call it 11-12% discounts. So that's the tightest we've seen, really since this whole saga began.
And Greg, just on that one, sorry to interrupt. Like having those discounts basically at parity, to me doesn't actually make sense. Like I feel like Ethereum discounts should be trading at a discount relative to BTC, given the path forwards there is less clear than Bitcoin. But I don't know, am I missing something there?
Yeah, I think so. It's a great point, and I agree with you. From a rational standpoint, I think what we're seeing is, the grayscale discount was wider than we really expected it to be for so long. And I think part of that is because people just, didn't believe that this path was possible. And so you had this massive discount and it looked like, a relatively easy trade. And they just ignored it. And that's why we were trading at, a 20% discount just, a few weeks ago. Now that we're getting closer, I think people are saying, okay, I'm not going to be fooled again. And they're going into the Ethereum product, and they quickly tightened that, basically in line with where Grayscale is. I think here Grayscale is probably a better trade, again, because we have a firmer timeline. But you are seeing folks go further out the risk curve and into ETH. And some of the other trusts like Solana, for instance, now they're not very liquid, but that trust is actually trading at a huge premium that really harkens back to 2021 and 2020 for that matter. So I think you are seeing some dislocations as people chase performance here a bit.
Yeah, I agree. I was seeing the Solana one. I was almost thinking, are people going to start delivering in kind, minting, like creating the units of Solana and waiting a year? But I feel like hopefully people have learned from the past on that one.
Yeah, I looked into that. You can't borrow. GSOL is a very difficult borrow. So it's a tough one to put on, but it's an interesting one to look at. A trade that's a little more, a little easier to put on actually is basis. And that basis in our market is very pro-cyclical. As our market trades higher, basis expands. This is a chart of Bitcoin term futures basis, so the CDE contract. And we're seeing basis annualizing, near 20%, which even after all the capital costs to put this trade on is still, incredibly high. So for folks that, look at this market and say, I don't know how much more it has to run, basis is a great opportunity because, it's market neutral. You're earning high rates of return regardless of, whether or not, the market continues to run, trades down or does nothing. So we are seeing this trade both in Bitcoin and ETH bring a lot of traditional money back into the market.
Yeah, that makes a ton of sense. Thanks so much, Greg. Now, Sid, what are we seeing on the Web3 side of things?
Yeah, quite a bit of interesting developments. I think George mentioned earlier in the call about Salestrader and its pretty aggressive run up this week. It's up 160% in its native token TIA. But also this kind of theme of data availability has been a big one this week. We also saw a Near protocol. Near is a alternative L1 project from a few years back that they announced a data availability layer on Near as well. That basically Near could serve as a DA layer for rollups to post their storage state to. I think this is a pretty important theme to keep track of, especially as we're moving into a potential bull run where Ethereum fees start to rise. We already saw last week fees go up to 350 gwei, anywhere in the realm of double digits to triple digit dollars to make trades or do transactions on Ethereum. And more activity flows to rollups like Optimism and Arbitrum and Base. And then basically these rollups, they pay quite a lot of fees right now to store their state on Ethereum. And the proposed value add of these data availability layers is the state of these rollups can be stored on them on places like Celestia and Near. So potentially we see a world where more and more activity goes to rollups, and then as rollups scale, potentially they store their state on these data availability layers, which become massive storage layers for the execution state. And so, it was interesting to see Near enter the fray as well. And I know there's a few other players about to enter the fray. So a pretty key theme to keep track of.
And what happens in that scenario there, Sid, that you just outlined? What happens to Ethereum if that's not being used for data availability and they're using Celestia or something else? Then what happens to ETH?
So ETH will still be kind of the base consensus layer. We have all these validators, all of the staked ETH. So they it's referred to as a security layer. Kind of execution happens on rollups. The state is stored on data availability layers, and then the consensus, which is like something's actually been executed, is the proof is just sent to Ethereum. So just a small component of the data is actually sent to Ethereum. So we're not using too much of Ethereum compute or storage. We're actually just outsourcing that to all these other layers.
And
it should scale. It should scale.
Perfect. And I guess, like, how many of these data availability layers do we need? Is it like a winner take all type scenario, or?
Potentially could be a winner take all. It's kind of an integration game. So these data, each of these data availability layers needs to convince large rollups to basically store their state on them. So it's almost like a B2B kind of arrangement where Celestia needs to convince Arbitrum and Optimism and Base to store their state on Celestia. It's easier to integrate with one data availability layer as opposed to multiple. But I'm sure as time goes on, we'll see solutions pop up that kind of store state across multiple layers for redundancy and failovers and things like that. And so similar to kind of how current applications run on AWS, storing state in different area zones and different S3 buckets and so on and so forth.
Very cool. Very cool. Anything else on the Web3 side of things? Any? I guess what's happening with Friend Tech? We haven't heard about that for a little while.
Yeah, nothing too much, to be honest with you. It's TVL and activity is kind of flattening out on that front. Not many major updates have been made on the app. It's still a little buggy. So some folks have left, etc., and activity is kind of dying down. But I think it's TBD. Remains to be seen if the development team makes a pretty substantive overhaul on the app. Decentralized social in general continues to grow. I mean, more and more users are joining Farcaster, which is an alternative to Twitter, and other services like that. So I mean, it's still a theme to keep track of, but remains to be seen how this whole sector grows. In terms of other kind of big developments in Web3, the main one to note of also last week was a hack on the Poloniex exchange. So on November 10th, last Friday, folks, security teams noticed $110 million leaving Poloniex across Ethereum and Tron. And then later on, the Poloniex team confirmed that it was indeed a hack of the exchange. And one of the investors of Poloniex, Justin Sun, kind of offered a 5% bounty for the hacker to return the funds within 7 days. So that's still kind of out there. So we'll see if they do or not, but the funds are still at large, and a lot of them have already been swapped to other coins.
Interesting. Great. Well, hopefully they do get those funds back. It's funny, Poloniex has been in this space such a long time. It's one of the OG venues. But that's a wrap for today. Thank you very much, Sid, David, George, and Greg, and thank you all for listening in. We will be back next week with a special Thanksgiving version of the podcast, and we look forward to seeing you then. Take care.